So it's not that just grandma's losing a penny on a trade, or that, Fidelity, the mutual fund, is each time they trade, their 2 million shares, it's leaking a penny and 2 pennies, and they all add up to, so it's 30 cents or 80 cents or $2 or whatever. The issue is there used to always be a connection between Main Street and Wall Street. If you look at the New York Stock Exchange, Josh, there is a statue on top of the exchange, and it's beautiful. It's by, I think, a gentleman named Henry Ward, and it's called Integrity Protecting the Works of Man. And it has integrity in the center, it has science and technology on the left, and it has mining and manufacturing on the right. And how wise for the New York Stock Exchange to recognize there's a link between the real economy and the trading and the technology. Well, what's happened is since this high-frequency trading has gone about, it's squeezed out so many smaller regional brokerage firms who performed a very valuable function for the economy. These are firms that, for their local areas, they provided research. They knew the companies well. They helped them find investors. They helped them tell their story, okay? So that when they went on a roadshow and took these companies and they brought these companies public, they got them investors. More people invested. The stock price went up. It created wealth. And with that wealth, people went out and bought more products and iPods, or you fill in the blank.
And hiring.
And hiring.
We get
and
jobs
hiring
growth
workers.
in this country. It comes from new companies.
Well,
not just small companies, but new companies.
New companies and small companies is where all the job growth comes from. And in one chapter in our book, David Wield, who's an acknowledged, who's widely regarded as an expert on IPOs and capital formation, and his partner Kim, basically they make the argument that yes, the last decade has been bad for IPOs. Sarbanes-Oxley, Enron, WorldCom, loss of confidence, bad economy, bad stock markets, everyone's flat, this has not been good for IPOs. And then they say, but that doesn't explain it all. When they do their research, they've pointed out and found that the largest component, the reason why IPOs have been dying, is the market structure, because these companies are not getting their story out. They're not getting investors in the public markets where we all can share their wealth. Instead, where are the new companies?
So in other words, when there were reasonable spreads and less predatory activity, you could have a third tier and a second tier of broker-dealers who would make markets in the stock for profit and would write research on it and show the company to institutional investors, and all of that's been wiped out essentially, obviously by the markets.
They may have even lost money on the market making. It was a loss leader.
They picked up the banking business.
But they had other businesses that they could get into to subsidize
that story was the connection between Main Street and Wall Street, the economic growth for the real economy. And in this diminished capacity, how are companies coming public now? Angel investors,
they're trying to put
private
it off.
equity.
They're trying to put it off as long as possible.
Yeah,
another factor in this is that the high frequency firms tend to gravitate towards